Well, good afternoon, everybody, and welcome to the pre-Halloween 2020. Can things get any scarier than the year 2020? Edition of Bull Sessions. My name is Mark Robertson. I'm joined here by my dear friend and gifted investor and educator, Ken Kavula. Say good afternoon, Ken.
Good afternoon, everybody. It's certainly a nasty-looking day outside. I hope that your weather is certainly better than we're experiencing up in mid-Michigan today.
And I say good afternoon to Ken to remind him what time it is because he's got morning and late afternoon, and then we've got a round table tonight. So this is the afternoon version of whatever we're doing right now, Ken.
Okay, I have to put big signs in front of me as to what meeting I'm at, Mark, okay?
And we're also joined here by our special guests, Kim Butcher from Florida by way of Evansville. How you doing today, Kim?
Pretty good. The temperature here is 88 with the real feel of 96.
Oh, man. And we're also joined by Hugh McManus, who is with us here this afternoon. Good afternoon, Hugh.
Hey, everyone. How are you? I hope you can hear me okay.
Can hear you just fine. You know,
Perfect.
one of the blessings, if there is such a thing as a blessing from a pandemic, has brought us is Hugh actually is able to spend a little more time with us because he's grounded and the airplanes that he's normally on all the time aren't flying around quite so much. So we're kind of grateful for that. You're probably getting a little bit of cabin fever, wanting to get back in running around the globe again. Is that the case, Hugh?
Yeah. Yeah, I miss not being in an aluminum tube. Jealous of toothpaste.
Well, we're going to take advantage of your generosity this afternoon as we do a little bit on income statement and cash flow forensics, and we greatly appreciate that, Hugh. We'll spend a little bit of time talking about time versus timing and adding a few books to our book collection, but as a great pumpkin believer, I just want to give a shout out to the final days of October. We'll take a look at a few books, and that is not a bull. Third image from the left, that's something else. It is not intended to be any sort of a political statement or a knock on anyone or anything. It's just simply a graphic we'll explain in a minute. And, of course, the Hunt for Red October, it's our last opportunity until a year from now to talk about Red October in our quest for the best small companies. All right, just quick housekeeping here. No investment recommendation is intended. We will be mentioning a few real companies in real time. This is an educational demonstration. Again, no investment recommendation is intended. Everything is about illustration and demonstration. The opinions are our own. We might own some of the stuff that we talk about. If you would like an invitation to the roundtable in terms of a reminder, Natalie sends out a couple of them a month. We have a monthly webcast. The October session is tonight. But if you want to be added for future reference, nkavula1@comcast.net. If you have any follow-up questions, Mark R. at manifestinvesting.com. So let's go ahead and get underway. Again, we have kind of a standing agenda. We've been knocking out a few of the items on the agenda, but spending a lot of time on projected return on value. That'll be a subject of the conference coming up. Our best small companies results for this year. We'll take a look at where we stand today, but we'll be out with the new list here within a few days. Ken will be talking about our second COVID cancellation conference, the conference that we hoped we wouldn't have to have because we'd rather be in front of you guys and spending time with you. But the topics listed here are topics that we will tackle in future sessions, and there's some pretty good ones on there that I look forward to digging into. And again, you're invited to send questions or topics or issues, things that you want to discuss, and just whisk them in the mail to us via email, and we'll see what we can do. This is my stock market chart for today.
There's the rest of the graphic, okay.
And now it makes sense. Ken was really worried. I could feel it. I could feel it. I mean, is that not where we've been for like the last several weeks? And apparently the carrot fell off the stick within the last couple of days with what's going on. And that kind of messed up our donkey friend a little bit. Is the stock market down another 1,000 a day? Has anybody looked?
The last time I looked, Mark, it was actually pretty flat. NASDAQ was up maybe 60 or 70, and the Dow was pretty flat, but somebody else will have to fill us in on the last 20 minutes. I haven't looked in 20 minutes or so.
I was talking to a friend yesterday as it reached 1,000, down 1,000, and we don't want, I don't think any of us here watch the stock market on a minute by minute basis. So he expected me to have a huge amount of panic, and I just kind of sighed and said, "Oh man, well that's what the sigh is based on that picture." And the only other thing I would share in this regard is I don't know who's going to win the presidential election. Or frankly, when it comes to this particular subject, I don't care, and you shouldn't either, because it really doesn't matter who's in the Oval Office to investors. It's hard to accept that because we all like to feel like it does, but it doesn't. And have the long-term perspective. But I do believe that no matter who's elected, we are going to see some form of stimulus because we are still experiencing some level of economic pain and strife. And I think that there will be some flavor of stimulus, if not before the election, which is highly unlikely now, but afterwards. Any thoughts on that from any of the other donkeys in the audience?
I think whoever decides that they're going to get a political advantage rather than just helping individuals, unfortunately, I kind of feel that in the political environment right now, it's trying to say, look what I did, look what I did.
True. All right, so we'll just leave it at that. That explains what's been going on for the last couple of months on one slide. All right, just a quick note to remind everybody that we are going to have that second COVID cancellation conference called Successful Investing 2. Ken will have a few more words on it here as we close up the program, but we're going to focus in on the stock pickers and stock contests and sources of ideas, and it's individual sessions over that 3-day period shown there. Any comments, Ken?
No, I've been starting to prepare materials for it. I know you have been doing the same, Mark, and the classes are coming together, frankly, much nicer than they usually do for me. I usually kind of wrestle with opening lines and with flow of what's going to go from slide to slide, and my piece of it is forming up real nicely. I'm very pleased with it.
Well, good.
We do have a great class from Cy coming up too on using other sources, where he's going to focus on sources beyond the stock selection guide and how they might help you do better analysis for a company, or at least validate your own thoughts about how you're putting together your analysis. So I'm very, very pleased. We're going to have a great stock panel talking about stocks that are favorites of theirs. And if our past panels are any indicator of our future panels, you're sure to come up with one or two really, really good ideas.
Yeah, I'll be out with a little more on that probably later today, depending on how much time the roundtable takes up later today. But Ken, on the all-important question, now I allegedly had a portfolio that I turned into the contest a year ago that had tremendous opportunity for improvement a few weeks ago, and it had improved. Is that still the case, or
you're not in last place, Mark?
this is
Oh
important.
no, I thought I was in last place.
No, this is the stock pickers contest from mid-Michigan, and Mark always puts an entry in there, and unfortunately, it doesn't spend as much time in that entry as some of our clubs evidently do, because he manages to move down that list on a fairly regular basis.
Yeah, I don't get it, because
well in all the other contests. I don't know.
The winner's circle and I are a stranger up there, and we have to figure that out at some point. But I do have to point out for the audience that's worried about me is I do have actual certificates from Ken for a few times around the block. So, all right, Ken, I think we can actually stop whispering. I'm knocking on wood. You guys heard that. 3 days to go, and our best small companies for 2020 run out, but we are running at about a 5 percentage point advantage to the Wilshire 5000 unless something really happens dramatically disastrous for the small company stocks. And we certainly hope that's not the case. You can see that it's been a real mixed set of results, but it all adds up to a pretty nice result. And a few of you apparently did get out there and buy some Planet Fitness for us. We appreciate that. We asked you to get out there and buy some CyberArk too. Hopefully you're not done shopping, but any price support that you can provide would be greatly appreciated. So we'll be getting to work on the next 20 here. In fact, Ken and I will be starting the formal effort tomorrow. So it's always interesting to me, Ken, that you definitely get a rule of 5 spread on these, that every year we see this type of a distribution.
Yeah, I don't know what to make of the fact that we have a majority of this list this year, at least, not beating that 5-point spread, or not even beating the market itself. But at the same time, overall, we're doing quite well because we've hit a home run and a good solid triple with the top 2. It runs like that on some years. To be honest, I'd be very pleased if we put together a list where that green in that last column extended all the way down to, shy of 3 or 4 of the stocks, and where the top one didn't even go into triple digits. I really like having a more balanced group of stocks. But for those of you that decided Etsy was a good buy a year ago, I know how happy you must be with almost a 200% return in just 12 months. So it's these small companies are much more unpredictable than their larger counterpoints a lot of times. And sometimes I can't figure out any rhyme or reason. That's rule of 5, isn't it, Mark?
Yeah.
There doesn't seem to be any reason why some of them do what they do. I think we spoke last week about Cantel Medical being on our list 3 or 4 times, and it always looks like it should be a real winner, and yet it never seems to happen. It just never seems to happen with that stock.
Yeah, and I would just point out that I could probably not bring myself to have bought Etsy a year ago. And anytime you cherry pick a list like this, just be aware of what you're doing, because I can tell you flat out, a year ago, if I was trying to pick 3 or 4 of these, I probably would have picked Cantel, Paysign, probably Canada Goose, and a couple others towards the bottom, wanting to stay away from any of the weird medical companies or the retail companies. And the message there is you pretty much have to be bold when you're shopping in this environment.
My daughter's not very interested in the stock market at all, but every now and then she gives me an idea. She gave me an idea about Pinterest a couple of years ago, and she gave me an idea about Etsy. And I usually discount anything she has to say because it comes without any knowledge of the company. She's basing it entirely on the product, but she's in love with Etsy. So if it were up to my daughter, she would have put a lot of money into Etsy, and she'd be sticking her tongue out at me right now, telling me na. So,
I believe she's the one who came up with Zag a few years ago too.
well, that was my granddaughter with Zag.
Zag, yeah.
With the phone, the covers for the phones.
Zigging, zagging. All right. Right now, this is a very, very, very preliminary / draft underscored, bolded draft. But these are the companies that have exhibited growth rates greater than 12%, quality ratings greater than 60, will probably demand some level of earnings per share predictability or stability that's not on here. But these are sorted by owner's return on value, that owner's prove column right down the middle, looking for double-digit proves with all the other attractive characteristics. Now, some of these get jettisoned just on size and other considerations, but this is the type of list that Ken and I will be sitting down and whittling away at here over the next several days. So that's just an update from last week's list. And yes, both of the boat companies are still in there. So we'll have a boat race as part of what we're doing.
I'm surprised to see is that X or K? It's an X. ASX still on the list at with its trailing 12-month sales at such a high place. I'm not sure that qualifies as a small company anymore.
I just left that on there because I know how much you like to remove jurors. It's part of the proper preparations.
I'll tell you, Mark, I have a sort for our initial list. Since we've been doing this, I've always taken the initial list and just gone down it real quickly. And if I didn't own at least 2 of them on the initial list, then I felt the list was incomplete. I happen to own 3 of them on the list this year. So I'm feeling that we've put together a fairly decent sort of companies that at least deserve a second look, if nothing else. So that makes me feel real firmly positive about the group at the moment, at least.
Yeah, and it'll percolate as we go, but that's where we stand right now, everybody. And again, it's all centered around the Halloween season. All right, Ken, we'll move on to one of your favorite subjects here. Timing the market versus time in the market. And kind of an interesting slide because they've got the bubbles backwards. The one on the left should actually be lower. But this notion of timing the market, tough subject. In fact, I've been talking to a number of people who are concerned about the election. This seems to happen every 4 years for some reason. And they really want to time the market. And our response is always, gee, find some really good companies at a good price and go for it. Just to make
I have relatives, Mark, that feel they can do this very, very, very precisely. And I have one relative especially who shall remain no more named than the fact that I'm related to them. But they're in and out of the market. It just makes me dizzy, that revolving door of raising cash and then putting it to work, and raising cash and putting it to work. And the extremes to which somebody will go when they think they have a hot tip on where the market's moving next. It's a bad idea in my mind, and I think long-term results have pointed to the fact that my relative is not doing nearly as well as a lot of the other members of the family that have bought into this idea that you really want to keep stocks for a reasonable period of time. And you want to sell only when it makes sense. And it doesn't always make sense to sell for an external reason that has nothing to do with the company.
Yeah, in fact, I'll admit to working with a few people just to identify some high quality, perhaps lower PE, higher dividend type funds, exchange traded funds that will serve a purpose of just calming things down for them a little bit. They're in these are people with substantial resources and pretty good risk tolerance, and they're pretty loaded up on the QQQs, the NASDAQ 100, and they're just looking to dial it back and maybe sleep a little bit better at night. I get that. That's okay. That's not the same thing. Anyhow, here's what the value line arithmetic average looks like since 1980. And as Cy likes to point out, even some of the worst looking bear markets, or that 2008, 2009 timeframe, even that's becoming a little subdued on this chart. He says bear markets ultimately become blips. That 1987 moment back to on the left side of your screen, when that happened, that was like the end of the world. Those of you that were investing and remember those days, that was like the end of the world, and you can barely even see it on here now. And of course, we've gone through a moment here.
There were moments in '87 when I thought that I felt my heart stop. So
yeah,
it really was. It was just an absolutely terrible time to be an investor. Kim, were you or Hugh, were you involved in '87 in what was going on in the market at that point?
Yeah, I was. I was just a nurse working 12-hour shifts and putting all my overtime into what options I had available through the work pension IRA and my own IRA. I wasn't really doing as much individual stocks then. I just was like, ooh, look it, it's going down. Dad always taught me it's great. You get things cheaper.
Yeah, I was watching the curve, but I missed everything. I had buys-in for Coca-Cola and McDonald's, but they didn't oblige, didn't get as low as I really wanted. And later in the week, Apple didn't either, all over. Huge regret. I was greedy.
Well, here I teed it up for both of you to say that you were way too young to experience the '87 crash, and neither one of you accepted the challenge. You both came in honestly.
Yeah, well, let's talk about the Great Depression.
Yeah.
All right.
It wasn't involved then.
I better bail out, Ken, and move on here. But by the way, Ken, you didn't ask me, but back in 1987, 1988, I was studying things like neural networks. I can actually show you some of the stuff. That was before I discovered the investment club stuff a few years later. So anyhow, Ken, this is one of your favorite slides. It's just a different form of presentation.
Yeah, I love these kind of slides where they show you that if you're trying to time the market, and if you're looking at yearly numbers, that they're all over the place. And if you're in and out of the market, especially in short bursts, you have a lot of chances to be wrong and to be out at deliberately great times in what's going on in the stock market. Or you come in too late, or you don't get out when things are really going badly. But if you count the number of downs, I mean, there's 6 downs, there's 3, maybe as many as 5 or 6 pretty flats, and the year-by-year returns, no matter which index you're going to graph, no matter which of the, whether it's S&P 500 or Wilshire 5000 or value line arithmetic, you're going to see this kind of I don't know if it's even volatility. I just think it's normal movement, and it's the kind of things that happen in a normal kind of market. Don't you think so, Mark?
I do. I think that by the time you act, most of the time, and I remember those days back in 2008, things actually started falling apart back around Halloween 2007, if you started to notice. And I suppose some of the market timing experts would have said you could exit and avoid some of that big green bar in the middle of the page, but I'd be hard pressed to make a case for it myself with any of the tools that we use. What I do know is that by November or Thanksgiving of 2008, we actually wrote about backing up the truck. And early into 2009, the turnaround actually began to happen in March. I begged my wife for the home equity loan between that deepest of the green bars and the tallest of those green bars. Again, just believing that no matter what seemed to be happening in the world, and it was a serious issue. I mean, Hugh McManus and I spent hours on the phone talking about the depths of the financial crisis. It was real. It was no hoax. But over the long term, the excellent companies were going to prevail. You had to believe that. And it's been pretty good since then for the most part.
I think human nature being what it is also, Mark, that it takes time to convince yourself things are really bad. And then it takes time to convince yourself things are really turning around. That you need a little bit of lag time on both ends of the depth, whatever the depth happens to be. That's something that basically I think was lacking here in 2020 back in March. You didn't have time to really get used to the idea things were really bad before they were turning around already and moving in the other direction. And that means that many of us lost a little bit of the ability to back the truck up and load up on things that we always have had on our wish lists, whatever they happen to be.
Absolutely. And then, of course, again, from the long-term perspective, this one, I think, does it all for us.
You're just looking back 10 years from each of the bars and doing a 10-year annualized return from each of the bars. Is that right on the graph, Mark?
Yeah,
Am I
like
interpreting this correctly?
Right. 1989 would be the 10-year annualized return between 1980 and 1989. And so you can see that there's only 2 bars below 6% in that 30-year period. It's actually 40 years. But in that 30-year period, and of course that 2008 moment shows up as a pretty special, in quotes, moment in time, December 2008, but pretty compelling.
So this isn't buy and forget investing. This isn't just plunk your money down and let it sit because it's always going to make money. This is still thoughtful investing and moving companies out of your portfolio when it makes sense, and keeping track of companies where the fundamentals have gone into complete disarray. But overall, what it does say is that if you buy and hold your high quality companies that it still makes sense to keep in your portfolio, you have a really great chance of having positive returns no matter what's happening at the precise moment that you're looking at.
That's an interesting point, Ken. I had never thought about this, but the value line arithmetic average is formed from the 1,700 companies in the book, and it is a somewhat actively managed index. I mean, we see about at least 50 new companies each year. 50 go away and 50 come, from the various results of mergers or bankruptcies or whatever. But there is a constant turnover in the 1,700 companies.
Yeah, because no matter which week the little thin newspaper thing gets mailed to you, says the dinosaur, the paper has a list of things that are new to that issue. There's always at least 5 or 6 new stocks to an issue that comes, and sometimes as many as a dozen or more. So I agree with you. And whether it's being actively managed by managers or being actively managed by the market, there's still a fairly good movement of stocks in and out of the index.
And it is all of the above investing. You guys hear us talk about that a lot, small, medium, and large. And that 2017 bump is really kind of compelling here recently. The 10-year returns, of course, that's fueled by what happened back in 2008, 2009 at the front end. But some pretty good stuff there. Notice that the long-term return, again, floats in pretty close to 10%. And I'm always fascinated by the professionals. In fact, I was watching a TikTok, probably my first TikTok video earlier today, where the guy was talking about 401ks being a complete disaster. And
was he dancing when he was talking about it, or?
He was moving around, but I'm not.
Okay, he didn't.
I'm not.
Wasn't wearing spangles or anything, was he?
He might have been on a skateboard with lemonade. I don't know. I'm not sure I understand all that stuff, but he was basically making the case against 401ks, and he was using a 4% long-term return in the stock market to make the case. And in my opinion, he could be right, but he does math differently than I do, looking at this chart. And he kept talking about 3% inflation, and I think inflation, at least over the last several years, has been closer to 2%. It was just I don't know. I just have to go back and think about what he had to say, because he was being extremely critical of locking up money in a 401k, and it doesn't mesh very well with what I would think of in that situation. Oh well, enough preaching. Time to move on and take advantage of Hugh's ability to be with us. Hugh would like to spend a few minutes talking about the book and the global subject he talked about over the last couple of weeks, quality of earnings. especially with respect to cash flow and digging in a little bit deeper, drilling down into some of the company's financial statements. So go ahead, Hugh.
Yeah, Mark and I have been talking about this for a while, and it really was driven by Tesla. And, well, really how I miss Tesla. It's not that I wasn't looking at the company, and it's certainly not that there wasn't a lot of information out there about it. It's a great deal of hype, but, you know, looking back on it, I really should have considered it more seriously. And that drove into looking at how can you look at companies that are profitable, and even if you look at companies that are profitable, how you can be sure that the earnings are not only accurate, but probably more importantly, sustainable, or certainly equally as important. So wanted to dig into the quality of earnings a little bit and how to look at them. And the topic began to explode into ratio analysis and a whole bunch of things like that. But I thought I would divvy it up into 3 separate weeks. Look at the general outline first, and look at examples, which I think are very compelling, from 1990 and perhaps into 2003 when there was a great buying opportunity, maybe 2009 as well. And then finally dig a little bit more into Tesla. And what I'm going to do is do it over 3 weeks, and it will lead up to the COVID meeting, which is coming up in November.
Nice.
Sorry about this, there's a dog that wants to go outside. So I'm just moving around, kicking her out, open, give her all the sound effects. So what I want to do, first of all, it dawned on me that I should look at it, talk at least a bit about accruals and accrual accounting, but I'm not going to go into that in great detail. We know that when we look at financial statements, that they're not reporting how cash is flowing. And people have asked for more discussion on cash flow, and I think it's not a bad topic to get into. So we'll touch on it tangentially here a little bit. But the fact of the matter is that in accrual accounting, you're looking not when cash flows, but when a revenue is earned. In other words, when a company recognizes its revenue, it may get paid much later on, so there's an account set aside to monitor that. Or when it pays its expenses, it might incur an expense and recognize it in the balance sheet, but it may wait to pay off in cash. And so there's often a difference between when earnings arrive on how cash moves. And that's one of the big issues in accounting, and certainly in delving into the quality of earnings. Then another aspect of all of this is to take advantage of the fact that many companies have inventories, and inventories, buying things to manipulate and manufacture into something else so you could sell, is a scientific process, or at least it's a rational process that involves predictions into the future. And sometimes if your predictions are wrong, that impacts what happens to your inventories. If no one wants to buy them, at the end of the day, you're going to have a whole bunch of finished goods that you can't sell. Or if you suddenly realize after you bought these raw materials, and there's a lag between buying the raw materials, putting them all together, getting a final product and shipping it off to a customer, if that's a multi-month lag and the market has suddenly turned down, you might say, well, listen, I'm not going to convert these raw materials, I'm going to do something else. But you would see a buildup in that sort of inventory. So this activity is very useful for projecting what may happen in the future. And certainly, if you see it happen in a number of different companies in the same industry, then you know it's a more of an industry-specific event rather than a company-specific event. And that was very much the case in 1999. It was dramatically the case for companies like Dell, and Intel, and Cisco Systems, and Lucent Technologies, and a whole bunch of companies like that. They signaled very, very, very clearly that the dot-com bubble was coming to an end, yet seemed to surprise everyone. So skipping along to the next slide, we're doing a little bit of overview here. So we've talked a bit about accruals, that net income and cash flow differ because of accruals, because you may say, listen, I'm recognizing this revenue today, this quarter, even though cash will not come across the transom for maybe up to 3 months from now, but it's going to sit on my financial statements as being recognized revenue. Now there'll be a receivable or something equivalent on the other side to counteract that until cash wipes it away. But accrual accounting is a method where revenues and their expenses are recorded when they occur and not when the cash changes hands. And it's built around the principle that you recognize revenues and expenses together. And the accrual is the portion of income that isn't accounted for in cash. So very often you have depreciation as a classic example of an accrual. Let's move on. And when earnings and cash diverge, so this is a key point when looking at an income statement and a statement of cash flows. When they diverge, it's always got something to do with accruals in one way, shape, or form. And companies can tinker around by building up inventory. You should watch for that to happen, particularly if sales are weakening. I touched on that a second ago. They may adopt a more aggressive revenue recognition approach. So in other words, if a company gives a handshake that we're going to buy this, but you haven't yet got the PO, they may say, listen, we've committed to this on our books. This is not going to be sold. These items are not going to be sold to anyone else. So basically, why do we not just recognize them now as a revenue? Most companies would not go that far, but some will on occasion, at least in the past. They can tinker with what's called the allowance for doubtful accounts. So there's always a percent of revenues that you recognize that you think, you know, that company's a bit iffy. Maybe they will not actually pay us. And you can tinker with this allowance for doubtful accounts. Debt reserve is often called. It's a contra asset because I should have had a proper. Sorry, I just noticed a little correction I didn't make there. But it's a contra asset because it takes away from revenues. And often related to that is when things start to turn sour. Sometimes to shift items out of a warehouse, companies might loosen their credit requirements and to bolster sales, but they may not tighten the allowance for doubtful accounts. They may apply the same criteria to, say, in the case of mortgage, a very solid person who puts 20%, 30% down, they may apply the same allowance for somebody who is, we call them liar loans, people who just state their income and their ability to pay back on a sheet, and there is no checking or verification of these items are correct. So let's move on to the next one. As I said, it's about when these two things diverge. Very often, and it's an important thing to look for, it's not something to panic over, but it's something to certainly understand. If you see cash flow and earnings diverge, it could be a warning about the quality of earnings, that it's declining, but it's certainly something at least to be aware of and look at. And I agree with, I certainly would agree and support the idea that we should, as a community, look a little bit more closely at cash flow and get our arms around that and understand it a little bit more. So skipping along, when they diverge, and I touched on these a couple of seconds ago, but you could look at the following. If growth and you could look at growth and operational cash flow versus growth and earnings. They should go in parallel. Rate of depreciation versus that of capital expenditures, again, they should be in sync. And if these things start to diverge, it's worth probing a little bit more. Growth in sales versus receivables, again, should be in sync. Growth in sales versus earnings, we all know from part 2 of the SSG that we like to see these two things in sync. And sales versus inventories. So we skip along. For inventory analysis, what we're going to do is really just look at 3 different areas on an income statement, the balance sheet. We look at revenues, accounts receivable, and inventories. And for a manufacturing company, this is key because inventories are often broken out into different components. The raw materials, which we'll chat about in a second, the work in progress, as I like to call it, most people now use work in process, and final or finished goods. So if we move on, we can talk about, I believe the next one's about, accounts receivable. Yeah, the point is the companies run on credit and payment and cash flow aren't always in sync. The revenue recognition and cash flow aren't always in sync. So the transfer of cash is delayed. And this is a pillar of accrual. You create an accrual in accounts receivable to accommodate the fact that you have not yet received, but you're planning to receive cash for revenue that you've recognized. So we skip along. The turnover ratio is something that we will look at when we're analyzing these inventory components of inventory, but it's sales divided by receivable. And generally, large is good. You want people to pay their bills as quickly as possible. So you want a very small receivables account compared to your revenues. If it's too high, it's often a sign that maybe your credit terms are too stringent, which means there's potential customers. Some of them may not pay their bills, but there are more that will, and they're potential customers that you're losing out on. And if your accounts receivable ratio is too low, because low is generally speaking bad, but as long as you have a consistent trend, that's important. But if it's too low, it means that you have problems getting cash from your customers. You have too generous payment terms, maybe for months. Many pharmaceutical companies today insist on paying their bills in 90 days or in some cases 180 days, which puts a lot of strain on their supplier. But when you have a situation like that, you have a very large accounts receivable entry on your financial statements. But watching how the accounts receivables change over time, particularly accounts receivable to sales, is key. So skipping along, and we'll see examples of these later. So this just kind of shows you the ratio, or it's a chart really that shows if sales are growing at the same rate as receivables, that's generally good. So you could be up on the top left, or you could be in the middle, and that's fine. They're growing in tandem. Everything is happy. Things are looking good. Where you don't want to be is shown on the next slide, and that is when, on the next slide, very similar chart, but you can see that if receivables are growing and sales are dropping, that's a really bad sign. You're probably extending too much credit. You're trying to push inventory over the transom out to customers, and it seems to be customers that really aren't in the best of shape to pay for it. It's a clear warning sign. So skipping along to the next one, and I don't want to take up too much time, we want to look at inventories in more detail. This is the goal here, is to look at inventories in more detail and compare them to the receivables ratio, which I talked about earlier in the last few slides, and also changes in sales. So an inventory is a good that is ready to be sold, but it can also be a good that is being manufactured, or an item that you have just bought or plan to convert it into something else. And generally, manufacturing companies or companies that manufacture something, even property owners, will break out their inventory into different components, and that is a footnote in the full financial statements, which are found in the SEC filing, the 10K or the 10Q. And generally speaking, sales and inventory should grow in tandem. And if they don't, there's a reason. And particularly if it's industry-wide, it's a reason you should dig into it in some more detail. We move along. I think here we talked about raw materials. This is an example of AeroVironment. We'll look at 4 examples in total. You can see there they have raw materials, work in process, and finished goods, but they also show the gross inventories is always shown as well. They also show a reserve for inventory excess and obsolescence. This is a key one because especially in a company where technology changes quickly, AeroVironment makes it drones, so technology there changes really quickly. If obsolescence is growing, it means maybe the company really doesn't know what it's doing. Maybe it can't plan for the future. It doesn't understand its customers. And it's messing up, for want of a better term. KBH, many may own it. It's a homes builder, and you can see how they divvy their inventory, quote unquote, up. A little bit different, talking about homes and divvying it up into land. And if you actually dig into their financial statements in more detail, you'll see that they break it up by region, and they break it up by how much they've progressed in each region. It's kind of interesting to look at. I don't own this company, and I'm not very interested in home builders, but I do find it interesting how they handle their inventories, what they call an inventory. We skip along. Again, Intel and Tesla, kind of classic companies. Intel has always reported raw materials, work in process, and finished goods. And I'll show you the example next week of how that clearly signaled a problem in the world of computers. And then Tesla not only shows raw materials, process, and finished goods, but also shows service parts as well. And there's a key thing that happened to Tesla a few years ago when it acquired Solar City, I think, but it fired a solar roof product company, and now it has built into its inventories activity surrounding that whole very, very rapidly growing and very, very fascinating market, which I think is going to be a major contributor to the profitability of Tesla in the future. So we skip along. We just want to break the inventories up. Oh yeah, in general, just to echo what I said before, you would ideally like inventories and sales to go in tandem. So if sales are growing, you want inventories to grow. And if sales are dropping, well, you shouldn't really be piling up more inventory, particularly if you're good at predicting what the customers want. But if your inventories are growing, that red box in the bottom left, while sales are dropping, that's a warning sign. And that's something that you generally see across the board in many different companies as a downturn starts to happen. And just to talk a little bit about the components of inventory on the next few slides, we look at raw materials. Here I'm giving the example of making an omelet. They are finished goods. A raw material to one company is actually the finished good of another company. So I like to talk about a chicken or a hen. When a hen lays an egg, that's a finished good. But when the egg arrives in the restaurant, it's a raw material for an omelet. And it's usually given for a manufacturing company, detailed in, as I said, the footnotes to the 10Q or the 10K. And if we move on to work in process, as I said, I always call it work in progress, you make the batter. Generally speaking, it becomes a work in progress or a work in process if it cannot be converted back to the raw materials. So you make the batter out of the eggs, you've got a work in process, can't yet be sold to the customer, but it is an inventory item of some type, and it's reported on the financial as a result. Sometimes, say in electronics assembly, they don't stay on the factory floor or in storage very, very long, but other components like manufacturing of jet aircraft, they may stay in inventory for months and perhaps even years. So we skip along to the next one. You look at the finished goods. That's the omelet. You can't move it back to make batter out of it, and certainly you can't convert it back into an egg. And it's all packaged up, often ready to go to the customer. And the key thing is the risk of loss resides with the manufacturer. Generally speaking, a revenue would be recognized when the risk of loss is transferred to somebody else. That's when it's no longer an item. It should appear at least as such on the balance sheet of the company. So I think there's just one more slide in this kind of, oh, there isn't, but just broad introductory session to get us ready for what we're going to talk about next week, where we look at work in progress, raw materials, work in process, and finished goods in a little bit more detail, and show how they change over time was an omen for what was going to happen to the market overall.
Yeah,
so with that, I will move things back to our host.
Hugh, I have a question for you. What's the trigger for imbalance between the two quantities? Is it when one gets out of whack by 10%, or is it larger than that? Would you say 20%, or is it smaller? Would you say like it's as small as 3 or 4%? I noticed, for example, on your example of Intel here, that total inventories have risen, and they look like they've risen less than 10%. Is that a trigger for worry, or is that just normal kinds of interplay between the two, between the months, between the quarters?
Yeah, I mean, 10% may not necessarily be a bad thing. It depends on the company, it depends on the industry, and more importantly, it depends what is going on with sales revenues as well.
Okay, so the 20% rise in Tesla's inventories should start to open your eyes, though, and you should start to be asking questions at that point then, right?
That's right. I start to ask questions, and I start to look at what's going on the income statement. Generally speaking, ratios that involve the income statement and the balance sheet are to me, they're more interesting ones, you know?
Okay, thank you.
Right, and to be clear, Ken, I think he's going to cover Intel's actually gotten itself into a situation with the new generation of computer chips, and that I believe that shows up in an inventory analysis. Is that a good Reader's Digest to you?
I think so, yeah. This happens periodically with chip makers.
Yeah, because they're stuck with having to make faster, smaller chips, probably faster than they thought they were going to have to.
The purpose of my question is it's not automatically going to be bad then when inventories rise. They have to rise a certain amount before you start to worry about that, right?
Yeah, and sometimes it's actually a very good sign. If they're building up raw materials, particularly if you think back when they had this chip, which today, like, it's ancient history, but when the Pentium, when they were planning to launch the Pentium, for a couple of quarters before that, I recall, raw material inventory started to balloon. but they vanished very, very quickly once they went into production with this thing, the Pentium that was flying off the shelves.
Interesting, very
Cool.
interesting.
Look forward to digging into this in a little bit more detail. Let's go ahead and close things out this afternoon with just a reminder that so far we've named off 4 of our favorite books. We're going to name 4 more. A lot of the stuff that Hugh's been talking about is covered in a glove book, Quality of Earnings, that he had mentioned a week ago. And we're just going to kind of tack on some of our formative or influential or inspirational books about investing. And I think we've got one from Kim up first. Yeah, Kim, I think you're back with us, right?
I am.
Okay, go ahead and tell us about this one, because this one's a new one to me.
Okay. As my investing time has evolved, I recognize that when Buffett said management is a priority, I recognize the part of management that is so important is how well are they great capital allocators. And I am a Buffett disciple, and I go to the annual meeting, and I had found this guy, Jacob Taylor. He has a website that's called 5 Good Questions, and he gets speakers on with him, and it's a podcast. You can find it on YouTube. And he has some very interesting speakers, and they talk about their business cycle and what's going on and what should you look for. So I knew about him by that way, but trying to understand what capital allocation was, he actually, he admitted that that's the secret sauce of a business success and getting good returns. And I always understood it because I would give an analogy, you always want to have good return on your invested capital. Of the simple analogy, you have your house, got to update the kitchen, the wife wants $25,000 of a new kitchen put in, but if you're having a kitchen that's better than the whole neighborhood, you're not going to get your money out of it. So I understood that analogy, but I didn't understand really how do you find this in business and in the stocks that we own. And Jake wrote this book because he was trying to understand it himself. And this book, essentially, this was on his LinkedIn profile. And if you are an investor that appreciates finding great stocks, but you want to have a great capital allocator, believe it or not, if you have the great capital allocator, you can get 20 times the returns because they are so effective with how they manage the money. I've read this book twice already. I imagine it's going to be on my list to read every year. And he writes it in a way that it's like a novel of, a young man trying to figure out what he wants and what's the best path to be on, and all the stories in there are different examples of what capital allocation is, so that you could recognize them in your own stocks that you may want to have within your portfolio. Part of this book has also helped me recognize that I want to have stocks that have great capital allocation and great management. And in doing that, I have a set ratio of what I want to have for ROIC before I want to own a company. And that is part of my personal checklist. So I think this is a great example of a book that you could read to help you understand capital allocation and why it is so important. So I hope the rest of you enjoy it. Now, he does have, like I said, he does have a podcast called 5 Good Questions. I would also suggest you look at that. And I hope everyone else agrees that this is a really great book. It just came out at the 2019 Berkshire Hathaway meeting. So it's a new book.
Good stuff. Well, thanks, Kim. I think that the subject goes very nicely with the Greenblatt stuff and the return on value and all that type of thinking of good strategic use of capital. So I'm sure we'll be spending more time with it. All right, Ken already took my second pick last month with the Intelligent Investor. So now he's going to try to, beat me out on a few more selections. So go ahead, Ken.
Oh, I'm sorry, Mark, but this is one of my most favorite books when it comes to investing, or maybe just about philosophically how you talk to your children if you want them to be successful going forward. I'm not the product of a rich dad. I'm the product of a very hardworking poor dad. And so I didn't hear a lot of the things growing up that rich dads talk to their kids about. I wasn't even aware that I was talked to in a whole different way than some of my fraternity brothers at college. I went to a highly selective liberal arts school, and it was filled with a lot of kids that had a lot of money. And I watched them do things with money that appalled me. And why did they do it? Because they could. This book explained a lot, and as I reread it, and I've probably reread it 3 times now, as I reread it, I continue to think of things that I should be saying to my own kids, and maybe I'm too late to say it to my son, but I'm not too late to say some of these things to my grandson. So I'm using it as kind of a skeleton or a spreadsheet to move my grandson through some lessons that I know that he's not getting from his own father, and I know that he's not able to pick it up on his own. It's not stuff you do pick up on your own. You need somebody to help you out a little bit. So Grandpa's going to be there with some of the things that Rich Dad should have been saying if he had a rich dad. I think the book is superior. It's an easy, enjoyable read, especially if you're a father. And I just can't say enough about the whole thing. I'm surprised at the number of people that are Kiyosaki disciples and that begin their discussion of investing by telling you they follow the Kiyosaki way. It's a little bit cult-like in some respects, but I think you'd gain a lot just by reading it yourself, and especially if you came from circumstances that didn't involve a whole lot of money as you were growing up.
Absolutely. Well, that last sentence there reminds me of you and I have both been following Graham Stephan on YouTube a little bit, and he just bought a multi-million-dollar duplex in Las Vegas, and he rents out half of it for his mortgage payment. So he's living in his half free. So that's how rich people do that sort of thing. All right, Hugh, we take Hugh down and ground him, and he gets all cerebral on us. So he wants us to get into this stuff a little bit more too. Take it away, Hugh.
Well, I think, yeah, there have been some questions in the last few weeks about cash flow, and obviously I used to be intrigued by it, very exotic. I did an MBA and studied cash flow, but didn't really learn much, I don't think. But I found this book, it's probably 15 years ago. I think it was published, close to 20 years ago it was published first. But it's called Creative Cash Flow Reporting, and as you can see from the subtitle, it's Uncovering Sustainable Financial Performance. One of the drivers for me often was when companies paid dividends to figure out if they were sustainable, because I used to have this hard and fast rule that if a company ever cut its dividend, I would sell it and I would never buy that company again. But, then the financial crisis came around and companies did cut their dividends for very good reasons and ultimately brought them back again. But one way to learn about whether or not a dividend is potentially sustainable is to see if the cash flow of a company is healthy. We tend to look at earnings, but cash flow is very important as well. In fact, I would say it's somewhat critical. We tend to skip over the statement of cash flows as well, but there is a lot of information in there. And this book, yeah, it can be a bit technical, I will agree with that, but I think it is a very good primer into cash flow, the components of cash flow, what to look for in changes in cash flow and what it might mean, particularly in the context of looking at the income statement as well. And ultimately about the sustainability for a company. You don't have to be an accountant to read or understand this, but it's certainly something that accountants, I think, would like. If you have an accounting bent, you're going to like this book a lot. But for somebody who really wants to understand well the finances of the company and how, shall we say, iffy reporting can be detected. Bad smells we often can detect, but we don't know what they mean. This will help you recognize exactly what that odor is, and if it's something that is a decaying flesh in the company, and should be a warning sign for you to abandon ship. So I'd recommend this book. It's a really good book.
Always the visual olfactory one, Hugh. Thank you. I can remember the one of the Dallas leading educators. It might have been Lila Husband pulling me aside after a presentation years ago in Dallas, and she said, "Where do you pay dividends from?" And I said, "Earnings." And she said, "That's partially right. Try again." And she says, "It really comes out of the company's checkbook. You got to understand the whole structure." And she's right. I mean, you paid out of the checkbook, so you got to be watching the stability of that. All right. My book for this week is one that is familiar to many people in this audience. It's the NAIC Investor's Manual for the Individual Investor. It's been out of print for many years. There was a 1984 and a 1989 edition, largely written by George Nicholson, but also contributed to by Thomas O'Hara and Ralph Seeger and Helen McLean, and I think there was a couple others, a gentleman out of Indianapolis, the name escapes me. But again, it basically introduces everybody to this concept of you can succeed as an owner, a steward of excellent companies over the long term with a long-term perspective. And I would encourage you to grab a copy of this book. And it's not the most literary read. I mean, it's a bit of a lunge to read the whole book, but
Go on, just say it, Mark. It's crudely written, but you have to get through it, okay?
But what's not crudely written is that first introductory sentence. This book is like nothing you've ever seen before. It shows you how to take a vast amount of stuff, and we certainly have enough of that with all the chaos out there, and put it into a simple picture. And he's right. He boils it down to you really only have to know about a couple of the things that a couple of key factors to understand the investment potential of any company over the long term and how you can maintain a long-term perspective. So this has to be on my very short list, along with The Intelligent Investor and some of the other tomes we've already chosen. But again, we're trying to give you a smorgasbord of investment books that have been influential, inspirational, instructive, all of the above. And this one certainly qualifies. So
Mark, Cynthia is asking, do you have the right cover attached to the 1984 edition? I think I know the answer, but I'm going to ask you.
I think I do. But what do you think the answer is, Ken?
Well, I think the answer is yes.
Yeah,
that is the correct cover.
I'm 99% sure the two, the 84 and the 89 look like this. There was another one that came out a few years later that looks slightly different. And then, of course, it was rewritten, but I don't think the rewrite is as good as the original.
I think that's the copy I have. It's the 84, I'm pretty sure.
Yeah. All right, subscribe if you want to be notified anytime we post one of these sessions. Ken, I'll let you finish with a commercial and a closing thought.
Just about 2 weeks now to November 11th, 12th, and 13th. We'll be doing sessions. If you haven't already received an email explaining how you can enroll in these classes, if you want to send me or send my wife an email, we'll send you right back a nice response, which will give you the URLs for registration for all 5 of the classes. My email is kcavula1@comcast.net. My wife's email is nkavula1@comcast.net. And either one of you will send you right back a really nice sheet that tells you all about the conference and gives you the URL for registrations. You can also go to the Mid-Michigan chapter page on the Better Investing website. That's betterinvesting.org, not .net, .org. And you can also find registration materials on the Manifest Investing website under events.
Yep, and we'll be bolstering those materials here shortly. Now leave us with a frightening Halloween picture to enjoy. That's certainly been one of the more popular memes of 2019 and 2020. And just have a happy Halloween out there, everybody. Hope to see you at the October Roundtable, and we'll be back again a week from now with some hopefully not scary stuff. And just everybody have a safe and happy Halloween. And thanks, Kim and Ken and Hugh. Appreciate, especially Hugh. We love having you with us for these times and your sharing of your investing expertise. Thank you so much.
I'm more than welcome. Thank you.
And with that, we'll see those of you that join us tonight for the roundtable, and send me your stuff. Thanks. I have yours, Ken. But thanks.
Good afternoon, everybody.
Take care, everybody.
Talk to you later.
Mark and Ken, quick question. Do you have to be a BI